HSAs are getting a big upgrade. The IRS recently announced the new HSA limits for the 2026 tax year, which will increase tax benefits for almost anyone who uses these types of accounts. But that's not even it. The new tax bill is also proposing to double these tax benefits for millions of taxpayers. So in this video, you are going to learn what, why, and how all of these changes will work, and more importantly, how you can use HSAs to save thousands of dollars in taxes. So let's jump right in. Okay, so if you follow this channel, then you know that health savings accounts are one of my favorite accounts to use to reduce my own taxes as a licensed CPA and my clients' taxes every day at mycpacoach.com. And it is because the tax benefits are a lot better than a traditional retirement account. It's better than a Roth retirement account. It's better than a 529 plan and many other forms of tax advantage accounts. And here's why. An HSA is the only type of account that grants you a tax deduction for putting money into it and allows your proceeds to grow tax-free when you invest the money inside of the account. And it allows you to withdraw the proceeds tax-free when you use it for qualifying expenses. No other tax advantage accounts grants all three of these tax benefits at the same time. And that's why these accounts are so powerful. So personally, I am a strong advocate for most people using HSAs, not just to save on taxes, but to cover unexpected health expenses as well. Because let's face it, health insurance premiums typically rise every year. And the fact of the matter is that rising healthcare costs are the leading cause of bankruptcy filings in the US. So this is a very big deal. Plus, savvy taxpayers are using these accounts to grow their wealth while cutting their taxes, only allowing them to accumulate more wealth without Uncle Sam taking his piece. Now, to qualify for an HSA, all you need is a high deductible health insurance plan, which many plans are these days. And if you do, you can open up your own account on your own. Many people think that they need to set up an HSA through their business or through their employer or through their health insurance provider. But no, as long as you have a high deductible health insurance plan, you can set up an HSA independently at a variety of places. With that said, let's discuss the recent upgrades to HSAs by the IRS, which are going to go into effect for certain, and then we'll discuss some of the pending changes in Congress right now. So as of the 2026 tax year, individuals with self-only coverage will be able to put up to $4,400 into their HSA for the tax year, up from $4,300 in 2025. And those with family coverage will also be able to put $8,750 towards their HSA for the same year, up $200 from $8,550 in 2025. Plus, those 55 and older will be able to put an additional $1,000 towards their HSA in either year. Now, for context, a family contributing the max of $8,750 towards their HSA would save up to $3,200 in taxes if they were in the 37% tax bracket. Then, with a mere 10% rate of return compounding annually, those funds would be worth over $22,000 over a 10-year period. And all of this growth is tax-free. And then finally, if this family used their HSA to pay for $22,000 in qualified expenses that they accrue over time, then all of those funds would come out tax-free as well. Now, when I talk to my clients about HSAs and qualified expenses, many of them are actually surprised at what qualifies as a health expense, and it's more than what many people think, so let's touch on that really quickly. So most people think that HSAs only apply to doctor visits, dental visits, prescription drugs, and medical procedures, but that's only a part of it. You can also use HSAs for chiropractic treatment, and in some cases even massages, as well as therapists, psychologists, and certain weight loss programs as well. You can also use it to buy certain items from convenience stores like health products from CVS. For example, Amazon has an entire section of their website dedicated to HSA eligible purchases. Now, according to the IRS, qualified medical expenses are the cost of diagnosis, cure, mitigation, treatment, or prevention of a disease. And if your expense does any one of these things, then it may be HSA eligible. So those are the HSA benefits that you can count on for sure for 2026. But even larger tax benefits have been proposed as a part of the new tax bill, which would more than double these benefits for many Americans. So let's go over these changes as well, starting with the increased HSA contribution limits. Taxpayers making under a certain amount of income would be granted a bonus contribution equal to the current HSA limits. So in 2026, this would be equal to $8,800 for individuals and $17,500 for families for the 2026 tax year. Now, this bonus amount would only apply to individuals earning less than $75,000 if they're single, or $150,000 as a family. And remember, this is based on your taxable income. Higher earning individuals may still be able to qualify for these bonus contributions if their income, after taking all of their deductions, are below these ranges. For instance, a family with $175,000 in household income may be granted a $30,000 standard deduction if they are married filing jointly, bringing their taxable income down to just $145,000 and therefore allowing them to take advantage of this. And this is just a simple example, but more can be done here. Anyway, there are some other big changes in addition to these income-based limits as well, like the $1,000 catch-up contribution amount. So under current law, if you have a family plan where both spouses are over the age of 55, you are only allowed to make one $1,000 catch-up contribution. But under the proposed law, both spouses will be able to make the $1,000 catch-up contribution, doubling this amount to $2,000 for eligible taxpayers. And to add to that, there would also be new rules that would make it easier for certain individuals to qualify for HSAs as well. The proposal would allow taxpayers to convert unused FSA or HRA balances into HSA contributions when it is not currently allowed under current law. It would also allow individuals entitled to Medicare Part A to take advantage of HSAs as well, when they are considered ineligible under current law too. There were also certain health plans that were considered ineligible despite being high deductible plans, like certain bronze plans with maximum out-of-pocket costs that were too high. This proposal would make those health plans HSA eligible as well. So altogether, this proposal will increase access to HSAs for millions of people and increase tax benefits, especially for middle-class families. But even without this proposal, the tax benefits of using HSAs for any family have always been strong and should be carefully considered if you have a high deductible health plan. As a self-employed individual myself, I intentionally choose high deductible health plans when I pick insurance because of how powerful the tax benefits are, which may or may not be best for you. But if you're considering using an HSA, be sure to talk to your financial advisor about it or your CPA. And if you need help with that, just apply to work with my team of CPAs today at mycpacoach.com.